Both the IMF and the Bank of England have warned soaring AI stocks are a bubble risk, but are they right? IMF Managing Director Kristalina Georgieva said on Wednesday that today's valuations are heading towards the level of the dot-com bubble that popped 25 years ago, while the Bank of England has warned the risk of a sharp market correction has increased. The S&P 500 is trading at an average 25 times earnings. That's not as high as the dot-com bubble of 2000, but it is edging ever higher, while gold pushed through $4,000 an ounce this week. Altaf Kassam is Europe Head of Investment Strategy and Research at State Street Global Advisors. Altaf, are the IMF and BOE right to warn of a bubble?
I think the historical comparisons are telling. Not many people were around investing during the dot-com bubble, but I remember a similar phenomena. But what was different back then was a couple of things, I would say. One, all stocks were being pulled up together, including small, unprofitable stocks with no revenues. At the moment, it's being led by large stocks who are actually delivering earnings, and that's important. There is something behind this. And secondly, there's a whole new industrial policy happening in the US, which you've seen with the way companies are taking different stakes in each other, and that's being encouraged by the government, who have also taken stakes. And so not only do you have this tailwind from the government, but you also have the fact that these companies are actually profitable and justifying their valuation. So it's right to be cautious, but I wouldn't say the parallels are exactly the same as the dot-com bubble.
Not all these companies are profitable yet, though. OpenAI, for example, is a long way away from it. And it's also, these companies are quite reliant on deals with one another. OpenAI plans to buy chips from NVIDIA and AMD that will also give it shares in the chip makers. Is there too much circularity in a small group of companies here?
Yeah, and I think that is the point that both the Bank of England and the IMF made, which we have been making as well, that the risk here is more about the concentration. And when you have a market which is pulled up by a few stocks, that's a worry in itself. But when those few stocks are all exposed to the same theme, and like you say, when they're actually investing in each other on top of that, then we become a lot more worried. And that is something that we're definitely keeping an eye on. As I say, for now, it feels like the investment is being rewarded by the results, by the return on equity. But when that starts to falter, or if that starts to falter, and we'll keep a very close eye on next quarter's earnings, then we will start to encourage investors to take a bit of a different approach.
Is the gold price at this level also a market warning sign, Altaf? How much is that about fear?
Yeah, there's a few things going on. Definitely, it's about nervousness in the market, worries about the US dollar, the erosion of the US dollar as central to the global financial system. But there's also some structural forces which frankly would continue whether we were in this market situation or not. And that's central bank buying. They're looking to diversify their reserves. They're buying gold. That's growing interest in exchange traded products, which are backed by gold from retail and other types of investors. So there's a couple of forces which I'd say are structural, which are going to continue regardless of the market situation. But there's definitely an element which is general market nervousness, which is also helping push the gold price higher.
Do you think it can keep going higher from here?
Like I say, those structural forces, I think, are going to persist. At the same time, we believe that in the medium term, we could see another 10 to 15% fall in the US dollar. At the same time, we also think that, we could see 2 more rate cuts from the Fed this year, 3 more next year. So put that all together, there are definitely forces that could keep the gold price moving higher.
To predict the outlook for the Fed, of course, we need economic data. We're more than a week into a shutdown in the US, which means no official numbers. How much is that a concern for investors?
It is a concern, definitely. We have moved post-COVID into this era of data dependence. Central banks relied less on forward guidance. They stopped telling us what they were going to do and told us that every data point would be scrutinized. That became less tractable as data became less reliable. We had lower survey results, participation, and and data kept being revised up and down as well. And add to that the fog that's coming down because of a government shutdown and certain data being released. What's good, though, is that we have a lot more unstructured data out there that we can rely on that we never used to be able to rely on before. For example, we scrape the internet every day to generate what we call our price stats series, which is like real-time inflation. And there are lots of other series which look at employment, which look at consumer confidence, which we can literally generate in real time now, given computing power and access to unstructured data. So we're not quite flying blind, but like I say, that the fog is coming down, and the longer this shutdown persists, the more difficult it's going to be able to understand what the central bank reaction function is going to be.
That was Altaf Kassam of State Street Global Advisors. Don't forget you can watch more videos on Reuters.com.